Hey, Dan Passarelli of Market Taker Mentoring here. I talk to a lot of traders and they talk about using implied volatility in order to predict future movements. Now, what does that actually mean? What does implied volatility really predict? Well, when we talk about option volatility, whether we're talking about historical or implied, both of those are stated in units of annualized standard deviation. And so, if we consider what standard deviation is, it's just simply a measurement of anything, but in this case, closing prices of stock prices over a certain period of time. And we look for the deviations, the variations of the move. It measures the volatility of that. So we would see 2/3 of all data fall between down one standard deviation and up one standard deviation. And if we were going to use historical volatility and make predictions about the future, then we would say if this is what it was like in the past, 2/3 of the moves fall between up and down one standard deviation, then that's what we would expect in the future. But people use implied volatility because that's what the market is pricing those options at supposedly based on their assumptions about future volatility. So what we do is still, if we're using annualized standard deviation, we're saying that in the future, 2/3 of the moves will fall between up and down one standard deviation. And so what does that predict? It doesn't necessarily predict anything except for the volatility. It doesn't mean that moves will be that amount. It means that some of the moves will be less than that. Some of the moves will be more than that. In fact, 2/3 of the moves will be equal to or less than that amount, and 1/3 of the move will be more than that amount. It ends up being a pretty big misunderstanding as to what implied volatility predicts. So don't overcomplicate it. Just know that it predicts volatility. It's based on standard deviations, and don't read more into it than you need to. This is Dan Passarelli, Trade Smart.